All right, class, welcome to Chapter 4, Mutual Funds and Other Investment Companies. We'll not only cover this topic, but we'll also cover in great detail the homework assignment as well and sources you may want to use for information in regards to that. Investment companies, they're financial intermediaries that invest the funds of individual investors in securities or other assets. A lot of times you'll think about those as companies that sell financial products like Fidelity, Schwab, Vanguard. Those are a little bit different because they're also custodians that also have investment product. But a company like John Hancock, for example, is not a custodian, but they do make mutual funds. Um, so that's an important distinction. Net asset value. That's the assets minus the liabilities per share. So we'll peek here for a second. Um, when we're looking at this mutual fund right here, it has a daily NAV of 21.86. That's the price you'll pay for it. So you take the what the mutual fund owns minus its liabilities. The liabilities are generally um, fees that are accrued daily. There's not many other costs than that. And then you divide all that by the amount of shares that exist. One thing I'll mention about the share creation is that, in order to make a new share, they just make a new basket. By that, I mean buy the components that you see inside the individual mutual fund. And we'll talk about that as well here. So if I go down to this portfolio, and I'm in Morningstar right now, which is a very common and free analytics source for mutual funds. And I just scroll all the way down to the bottom. This is a emerging markets mutual fund. And we can see that their top exposure, 16% of it is in Taiwan Semiconductor, followed by SK Hynix and SK Square, um, and then a variety of other international and emerging markets names like Alibaba and Tencent. It's interesting because they also own Samsung. One comment about emerging markets is that South Korea is one of those that wobbles between developed and emerging in terms of how it's classified. So you'll see some EM managers that do hold South Korea. The investment companies, they have a few functions, record keeping and administration, diversification and divisibility. They have to create the shares, and one of the goals is to provide the investor with some kind of diversification. Professional management, and then lower transaction costs, right? It is actually cheaper for you to buy a mutual fund that invests in the emerging markets than trying to buy those shares yourself. In some cases, you may not be able to buy those shares yourselves. You don't see too many of these, but a unit investment trust, that's money pooled from many investors, is invested in the portfolio mixed and a portfolio fixed for the life of the fund. They're just not very common anymore. They are more common in Europe. Managed investment companies, that's a professional investment management firm that manages a portfolio for an annual fee. There can be a load on that, which is a sales commission, and the funds can be open-end or closed-end. Open-end means they can create new shares. Closed-end means they have a fixed amount of shares. And there might be a reason you do a closed fund. Closed funds or closed-end funds, apologies, are also not as common. But if you were trying to sell a fund that maybe invested in some kind of real estate that you couldn't really create more shares of, closed-end fund may be more appropriate. Open-end fund that it issues securities and redeems its shares at net asset value. So the mutual fund company creates the shares, which are baskets of stocks. Going back here, right? You see the basket of stocks, at least the top names. You can go further down the list and see if there's anything else here. They also own Micron, which is interesting because this is an emerging markets fund, but it owns a US dollar stock, right? So I'll answer that in a second. But just going through the list, you can see what they own. Going back to the top, looking at the quote again, you know, when you buy a mutual fund, you actually don't do it intraday like you do with a ETF or stock. You put in your order and they clear all the buys and sells at 5 o'clock. And you really usually have to get in your order by 3:30, 3:45 to guarantee execution because they're going to buy with cash what they need for the sells and the buys. So they need to be able to X those out and then create the shares for the investors. Closed-end fund share price may not be redeemed, are traded at prices that can differ from net asset value. So closed-end fund is not guaranteed to trade at net asset value. There could be a variety of reasons for that. Usually, a closed-end fund you might see a discount on. Commingled funds are partnership investors pooling funds for trust or larger retirement accounts. There's also a professional management fee on those. Surprise, surprise, everyone wants to get paid. Uh, Similar REITs, uh, similar to closed-end funds, they invest in real estate, um, and they can also invest in real estate loans. Hedge funds, those are private investment pools exempt from SEC regulation, and can have a speculative nature. So, the traditional idea of a hedge fund was supposed to be like hedge your risk against the market. But what a hedge fund really is an unregistered investment vehicle that is exempt from most regulation. So basically, you can invest in a bunch of more odd things um, and be able to do it, right? And gather invest in money from investors. That's the big part of it. Sometimes they're speculative and sometimes they're risky. It all depends on the strategy of the fund. There are definitely many types of mutual funds. You have a money market fund that's basically acts as cash. We've talked about that in earlier classes. Equity funds, um, which are mostly stocks. And again, one thing I'll mention here is that mutual funds have something called the name rule, where if you call it something, it has to be 80% invested in it. So when we saw the emerging markets fund a second ago own some US stocks, my guess is that if we added them up, they're going to be less than 20%. And sometimes it's a classification issue too. You know, it owns Alibaba, but as of right now, Alibaba only trades in the US. I believe that's going to change and they're allowing it to be traded in China, which is odd for most people to hear that if you're a Chinese citizen, you can't buy Alibaba stock, only traded in the US. Um, there's also bond funds. They specialize in fixed income. Um, this is a bond fund that we use. It's the Brandywine High Yield Fund. Um, I have another page up which we'll review later. But it tells you what they do: a nimble, active strategy that seeks high current income and capital appreciation by investing in high yield bonds. So, it's telling us a little bit about its strategy. Invest in high yield bonds. High yield bonds pay more interest. The higher the interest payment, the more risky the bonds are. So they're investing in lower quality bonds in order to make a higher interest rate payout for their investors. Now, if we went through the same exercise here with Brandywine, the global high yield fund, and look at their holdings, what's considered a high yield? Well, actually, like Uber bonds are considered high yields. The payout might be different today based on pricing, but Uber bonds pay 8%. That's a fairly attractive yield as long as you believe that, Uber does not go bankrupt, right? They have a mortgage company. See here, I saw an airline, Allegiant. Get an idea for what they do. I see some home financing companies, oil company, Discover Financial. So, there's a lot going on here, right? Being an idea for their exposure. You can also see the credit risk of that bond fund, but we'll go back to this a little later. Global funds, international funds. Um, this is an example of an international fund, right? As I mentioned to you before, this is an emerging markets fund. I can look here and just see some of the sectors. And let me see if I can get the countries here as well. Doesn't give you the breakdown of the countries here, but it's, um, 98% non-US with 6% in US equity. You can see their country holdings here. And what's interesting here, this is the fact sheet. I'll show you guys this again in a little bit. All mutual funds and ETFs have something called a fact sheet. So I'll bring that up now. This is a fact sheet. It's a two-pager that every company has to issue with a bunch of really valuable information. Um, it's telling me right here the sector and country allocation, and you can actually learn a whole lot by looking at um, what they own. So right here, the index has 12% in emerging market in Korea, but the fund has 31%. So we would say like the fund is bullish on South Korean stocks, right? Taiwan semi, sorry, Taiwan, they're at 19 with the in the index with the fund weighted 22. They're overweight Taiwan and overweight South Korea. You know, they have a 15% weight in India, but they're actually underweight the index. So they're showing more bearish of a posture towards India. Same thing with China, right? 25% of the index, they only have 12. And these numbers can change. I remember looking at this fund 4 or 5 years ago. It was much more heavily tilted towards China. And you can also see, what they're doing on the sector side. So 43% in tech versus the index at 25. They're very bullish on tech. So, when you look at like the character of the fund, you'd say this is like very heavy exposure to tech. Barely anything in real estate, underweight, utilities, underweight, healthcare, underweight, materials underweight. I mean, not surprising given that tech is eating up so much real estate in terms of the portfolio size. So you can see they're overweight in industrials, energy, communications, and staples by a little. Everything else they're underweight. You can also see their expenses here. We'll get into the different share classes in a minute, but when I buy them for clients, I buy them at the cheapest cost. If you're not working with an advisor or you don't have a minimum amount of money, you have to go into one of these more expensive share classes. There's also a balance fund, life cycle funds, or target date funds, right? Those are very common in retirement accounts and 401k plans. There's also index funds. Index funds try to match the performance of an index, usually pretty tightly, especially with something as big and transparent as the S&P 500. Then you can also have mutual funds that invest in funds of funds. These are still around, but they're significantly less popular outside of 401k plans because actually a target date fund is just a fund of funds that automatically rebalance over time. So when I say rebalance, usually in the target date fund or a life cycle fund, um, the life cycle fund will change its positions on stocks and bonds as you age. Basically, as you get older, it buys more bonds in that portfolio. And then just showing a mutual fund's balance sheet. This is not really too big of importance here. There's what are the costs in investing in mutual funds? So there's operating expenses, costs incurred by mutual funds in the operating portfolio. That could be cost for staff. for example. There's also, and that's what you would pay, right? But it's used to pay for stuff like staff. There can be a front end load, or a back end load, effectively an extra fee to enter the or exit the fund. These are much less common, but it's something I would look out for. You really want to be buying the cheapest share class if possible, or not have any hidden fees. There are some mutual funds. Let me see if I can find it right here. I think the Class A share. Let's look that up. I believe this share class right here has an upfront 5% charge just to get in, right? This one, the C class, does not have the upfront charge, but it has a higher overall fee. So these are just some of the trade-offs that you'd want to be mindful of. Um, there's also can be 12B1 fees. Ironically or not, these mutual funds actually charge their marketing costs to you, the investor, right? They allegedly say it is for shareholder liquidity. Um, Continue on this topic, fees, loads, and performance. Gross performance of load funds is statistically identical to gross performance of no loads funds. That's gross performance, but funds with higher expenses like do worse, right? Going back to this fact sheet here, when we look at performance of the Delaware fund over 3 years, the institutional class is down point two, call it 3%. The A share is down 3.25%. And it doesn't show the C class here, if I'm not mistaken. But you can see that the other ones, just have significantly lower returns because of those fees, right? The only ones that are better are these R6 share classes, which are used for inside 401k plans. You know that because the R stands for retirement. So when you see an R class, that's generally what it is. And it says here, compare costs with Morningstar, which is what we're doing here in this class today. So it's shown here that a Class A share, and usually when you see a Class A share, it denotes that it's going to have a front end load. Class C denotes usually a back end load. The difference in costs, even the 12B1 fees, um, can be different on each share class. And then, I class or institutional class shares, do not have any of these, right? They're pretty clean when it comes to costs. The problem is that you need to either buy it through, like when we buy it for our clients, we get to the benefit when we buy it of all of our clients' money. Some of these funds may have like $1 million minimum, you know, so you get the lower cost, you avoid these excess charges, but you need to buy it through an advisor. And that goes into like a whole bunch of stuff about the investment industry, right? Like the kind of marketing machine um, of mutual funds and ETFs and how they're sold in portfolios, how you discover mutual funds and ETFs to put in your portfolios. We'll continue on that. So NAV, um, an effective load, cost to initially purchase one share of the fund is a net. If there's a front end cost, basically you're paying the cost plus the cost of that front end load or fee. Stated loads typically range from 0 to 8.5%. So those are really egregious. I mean, really, there's so many options out there. There's not much of a reason that you should pay those kind of costs. I mean, for example, I really like this emerging markets fund, but if you had to buy the A class, which has a 5% load, and an ongoing fee of 1 point, even with a discount 1.42. I mean that's a tough hill to climb up as far as performance goes. Um, the load is designed to offset marketing expenses. At the end of the day, it's really designed to make these firms money, and it goes to the broker who sells the fund to the investor. Um, and that, what goes on there is also really interesting, right? Because, the broker who sells the fund, I mean, there's a lot of whining and dining that happens there selling the fund, right? You have a conference, you have a steak dinner, you have a guest speaker, right? They do a lot in terms of functions and activities to get people to even try to be interested in one of their funds. Fees and mutual fund returns. There's also can be soft dollars. Soft dollars have kind of disappeared pretty heavily throughout the industry as well, but sometimes and they're frowned upon. So, and here's why soft dollars are frowned upon. Soft dollars are frowned upon because effectively it's almost like a little rebate. Like, let's say I wanted a Bloomberg terminal for my office. Like as a fiduciary, I should not accept gifts from people I'm buying stuff from. It's almost it would appear to be a bribe. But let's say they're like, hey, if you buy our fund, we'll like give you a Bloomberg terminal. That could be an example of soft dollars. Or they provide me the research directly. Like, hey, I'll buy your fund, but I want you to share your research with me. That would be a better example of soft dollars. Rate of return is pretty easy. It's the current NAV minus the old NAV plus any dividends, bond coupons, or realized gains you may have got over the original price. So you can see here the difference between fund A, B, and C after fees. That can be pretty impressive, between the least expensive and the most expensive fund. I don't like the example here because fund A is basically an I class. It has the lowest fees, no load, and a 0.25% expense ratio. You know, Um, so, just be careful with that, just not to confuse it. This would be an example of an institutional class fund, given its low cost structure, versus the same investment that has a high cost structure. An extra 10 grand was eaten by the investment company there. General tax rules: fund not taxed if diversified in income distributed. The fund is not taxed, but the investor is. So, what does that mean? Well, if the fund owns Apple and sells Apple, you, the investor, pay a capital gain whether or not you sold a single share of that mutual fund. So you pay the taxes of that embedded in gain inside the fund. Next, you have turnover. Turnover is how much trading activity happens. Now, trading activity on its own is not good or bad, but it can be an indicator of, higher tax implications. So if I had, but how would you think of that in terms of investing? Well, high turnover usually means active, usually means tax inefficient. If I could hold a fund with high turnover inside a retirement account, that probably makes the most sense, right? Because the impact of that would be negated by the fact that it's in a retirement account. Taxation of mutual fund income. So fund pays commissions, costs on portfolio purchases and sales. They're charged against the NAV. The turnover rate is measured as annual total asset value bought or sold in a year divided by the average total asset size. So it's, like I said, how many times has your portfolio flipped? Um, let's see here if we can find that. So in the last year, this fund had a portfolio turnover of 2%. That is extremely low. right? And we know this manager, and he brags about his low turnover. He's buy and hold. Now, this is the bond fund, which said it was active. Both of these funds are active, but in terms of trading style, this bond fund has a turnover of 122%. It is very active, especially compared to the emerging markets fund. Exchange traded funds or ETFs, offshoots of mutual funds that allow investors to trade the entire portfolio. They trade like shares of stock. The big difference between ETFs and mutual funds, well, a couple things. One, they can trade throughout the day. There's banks that do these arbitrage trades so that the ETF can trade throughout the day. So companies basically provide the liquidity and act as a dealer, making money, like in the last chapter, making money on the spread between the buys and the sells. And they effectively create the liquidity that can be bought and sold throughout the day. ETFs started out as passive. They are still mostly passive. So it's easy to create historically. If you create an S&P 500 ETF, you're just taking the S&P 500, copying that, and literally, having that as an investment vehicle. You really can't make new ones of those because there's very few large players that control the market. Example of an ETF that's passive is the S&P 500. The ticker symbol that I use most is IVV. SPY is probably more popular, but it's a little bit more expensive than the share class. Another one, an ETF that is a little bit newer and active, is the JP Morgan Equity Premium Income Fund. Go right to the fact sheet. And the strategy here, I won't make us read it, is basically it buys stocks and then sells call options against the stock to generate income. So one thing I'll point out here is that this stock fund is generating almost 8% of income as of 8/31. But the other thing you'll notice here is that its return is 10%. So 75% of the return is coming from income because when you sell call options, something we'll cover later, you're taking income for the right to someone to buy the stock from you, right? So this is a very active strategy as well. ETFs have continued to grow in assets through a variety of asset classes, right? ETF are pretty much used in every single asset class. It's a really easy way to get exposure. Because they're passive and they're mostly copying an index. More recently, you've seen ETFs copy themes like a cybersecurity ETF or um, uh, I even saw like a Korean anime ETF or something like that. It was like a Korean entertainment ETF. There can be like a whole wide variety of these. Let's see if we can look it up. Yeah, K-pop. Why didn't I remember the name? This is an ETF that invests in companies that have exposure to the Korean pop culture, right? So these things can get very nuanced. Usually an ETF like that will be fairly expensive in terms of management costs. The you can get a S&P 500 fund for like 0.04%, but the K-pop ETF, let's look that up. Let's look it up on Morningstar. I will say something really interesting about this that I'll bring up. Um, just scrolling through it quickly, is I noticed something right here, which is a huge red flag. For a ETF to be profitable, it has to have $100 million in assets. If it doesn't have 100 million in assets, it's probably not making any money. You can tell they charge a reasonably high fee of 0.75, but if they only have $2 million in assets, you know, let me tell you how much money they're making. This entire fund is making $15,000 a year. There's almost no way this fund is going to be in existence next year, right? From a business model standpoint, how are they going to make any money off $15,000 a year? Now, if you flip that on its head, because I like to give you guys the business case as well, if it had $100 million of assets, it makes $750,000 a year. That could employ a couple people, right? Um, this is updated as of 2022, but ETFs are taking a bigger slice of the pie. A lot of reasons why mutual funds still exist is because of regulation. In most retirement plans, they only let you buy mutual funds. It's a very misleading chart. It's showing active mutual fund performance versus the Wilshire 5000. The Wilshire 5000 is kind of a wonky index. Instead of the Russell 3000, it's the 5,000 largest companies, which includes like small and micro caps. Just no one ever uses it, so I just find it to be an odd reference here in this chart. But oftentimes mutual funds, on average, underperform by the average fee, right? Doesn't mean it's impossible to find a good manager, but it just means that on average, you know, we're kind of average minus our costs. The other thing this chart doesn't show is like the type of funds that existed at this point, right? And the other reason why this is a bad chart, I always like to criticize a bad chart, is because it doesn't tell us anything. There's no numbers here. We can't do any analysis. It doesn't tell us over time. Trailing returns would be really helpful here instead of this chart. Consistency of investment results. Evidence suggests some persistence and positive performance over certain horizons. So, I mean, if you're looking for skill in an active manager, that's exactly what you want to see, like consistency of investment results. Like you want to see, like a professional athlete, you want to see good performance over a long period of time. That's the only way you know if they're making the Hall of Fame. So, how many mutual funds, outperform, over time? Not many. If you outperform the market by 1% a year on average, you're in the top 10%, right? By just outperforming by 1% a year. Some sources of mutual fund information. Um, First, you have the Morningstar website, which we've shown, the prospectus, which I'll review for a second, Yahoo Finance, Wall Street Journal. But for me, the best two are really the Morningstar page as well as the fund prospectus. I'll pop open the homework really quick as well. So choose three different funds from different categories: large, small, international. You can pick a bond fund. We use another bond fund called FBNDX. We use another bond fund called FISMX. Um, and that's really it for the mutual funds we use, right? We don't use too many. For each mutual fund, collect the following information, just the basics: 5-year returns, expense ratio, risk measure, try to find one of those. Now, while it's not listed here, um, well, actually, it is. Sharp ratio is one of the best measures for finding skill in a manager. Use the collected data and calculate the following metrics for each mutual fund: annualized return for the past 5 years, standard deviation, beta compared to the benchmark. All of this stuff um, can either be found on the fact sheet, or if you can't find it here, we have a 3-year beta right here. I would accept that. And if you can't find the information you're looking for, all you have to do is call this 800 number. They'll give you all the information you want. Um, and that was also part of the exercise. This will also be a good check to see who listens to the video this far and who knows to do that extra step here. Present the data and performance metrics in a table, just something easy for me to read. Based on the performance metrics, analyze and discuss performance and consider the following questions. Which fund has the highest return? Which one has the lowest risk? Which fund has the highest risk-adjusted return? Sharpe ratio. Now, in this exercise, I'm kind of having you compare 3 random funds, but if I was having you use the Sharpe ratio in real life, I would have you use it against 3 of the same style managers. Um, and then, was there an impact of the overall of the expense ratio on performance? I'll show you just a real life example of that here. For the Delaware fund, if we look at performance, ignore the Morningstar stars. You know, that's like an automated ranking. If we look at the fund here, it charges 1.17, right? That's a reasonably high fee for a fund. But we look at performance, performance is always listed after fees. Here we go. I switched to month-end performance. On a 15-year basis, he's in the top 13%. 10-year basis, top 23. 5-year, top 30. 3-year, top 37. 5-year, top 5%. I don't need the Sharpe ratio to tell you guys that this guy appears to be better than average over a long period of time, right? But the Sharpe ratio will also tell you that. The other, and that those are returns in his category after fees. Then you can look at on a year by year basis. Year by year basis tells you a little bit of a different story, but there's a couple of years where he has bad performance, but they're usually followed by pretty strong outperformance. The manager has told me that when he buys stocks, he holds them for a long time. And if he still likes them, when they drop in value, he buys more. In my first meeting with him, he said, when he has a bad year is the year to buy the fund, you know? So that's one item to look at here, just in terms of looking at performance. So this would be an example of like, yeah, it's a high fee mutual fund, but it's giving you the performance that you're paying for. And then we could point to other examples that, are not the case there for that at all. Some other things you can see, I would go to the portfolio page, another area to look at. You can see the price to earnings. So it's buying lower PE ratios than the average index, right? On a PDE ratio, but on a price to book ratio, they're a little bit more expensive. Price to sales, a little bit more expensive. Almost none of these are too off base. But that's just something to note, right? You can also see the sectors. These are a little bit different than the kick sectors, but that's also fine. This is a bond fund, so the characteristics of the portfolio are a little bit different. Obviously it's a bond fund, it's mostly going to be bonds. Actually, the rest is pretty much cash. Duration, which we'll cover later on in bonds, is the average life of the cash flow effectively. It's also a measure of its sensitivity to interest rates, and it's at about a 3. You can also see the riskiness of the bonds compared to its benchmark. So, triple B for high yield is like the best, and then double B is lower, single B is lower. So they're a little overweight lower credit quality companies, and then you can see their holdings. They also have a fact sheet as well that you can go over, look at additional information. I usually type in just the ticker symbol and then the word fact sheet, and all the information I'm looking for, comes up. Now, I will tell you, look, see, it gives the beta and the standard deviation right here. Um, Again, little treat for those listening. I will allow, the beta. I'll allow a 3-year beta, on that, and standard deviation. I'll allow 3 years on that as well. But anything you're missing here, if you don't see it, oh, this is a 3-year beta. You know what you can do to get that information, unless you want to go through the pain of calculating it yourself manually. You can go and call the 800 number, right at the bottom of the page. Not even at the bottom of the page, it's right there. So, that's just another piece of advice. It gives an interactive and real-time element to this subject and the homework assignment. So, that's all I have for you today, guys. Thanks for the listen, and see you guys on Wednesday.